Good afternoon, everybody. Welcome to Market Mavericks. I'm here with Scott and Mike. How are you guys doing? It's been a couple weeks.
Hello.
Great.
Awesome. All right. Well, we're not going to delay at all. This is what this show is all about, getting right to the action. And listen, we've got some big stuff going on. We've got economic data that's been slightly better, at least on the jobs front. We saw JOLTS data better than expected, ADP tomorrow. We got non-farm payrolls. We'll see what that is. We've got Middle East tensions and violence and, missiles and everything like that. Oil surging today. So I would say let's start there. Mike, what do you have for us on oil here?
Appreciate starting there. It's been, I'll start with an oil chart too. This goes way back. I still think big picture oil's going to $40 a barrel. That ain't nothing if you think at the pivot since you go way back and if employment keeps rising. But and there's one key reason. Here's a picture I want to point out. Oil's basically stuck at 70. Obviously, it's the risk now that we saw today that President Biden didn't really push back when asked about the potential that Iran might attack. Israel might attack, Iran oil infrastructure, which to me doesn't make sense. I mean, the first thing you should attack is whatever's hurting you, and so anything to do with missiles going your way or missiles getting into, but we'll see where that goes. So that's why it's bouncing. But the big picture I want to show you about oil is the key thing is it's stuck. I mean, here's this WTI stuck at 70, 73 maybe. It's still down almost 20% on the year, and it's bouncing, but it looks like it's just about to break down. And I want to show you one key reason why it hadn't broken down yet. I'm going to just add this one little chart here, and this is managed money net positions as a percentage of open interest. They are buried. I mean, hedge funds saw on top of this, they sold out everything and they're kind of potentially resetting. So it's definitely a level we could get a bounce. We should get a bounce. But the macro big picture for me, oil is very bearish. And I'll show you why. And that's one reason why. And this is the macro. Even if you do have an attack, there is a major animosity between Saudis and Iran. So Saudis would probably open up some of that excess supply. So it doesn't look like, even if we do cut off Iran's supply completely, they only export 1.7 million barrels a day. That's less than 2% of the total. And most of it's going to China. So it's going to hurt China the most. But I want to show you a key reason what's happening was different. Demand from China is rolling over. This is on the same scale as if you look at OPEC spare capacity plus US and China spare capacity exports. I mean, it's just off the charts, taking off, and China's turning over. So to me, that's the macro. If we do have some kind of attack, it's still bad for crude oil. And potentially, if we get a spike, it'll make it go lower.
So, Mike, but let's talk about what China's done recently, right? So they've been taking the bazookas out. So are you saying that that's not going to have an impact on oil demand at all? And is that why the hedge funds are so heavily short, because they really see the global downturn in the economy?
First of all, let's start there. You had an awesome trade. You nailed it a couple weeks ago. Maybe it was a month ago by China. And I think we both agreed completely. And for a main reason is who did not expect China not to stimulate? I mean, it's just a matter of time. It was kind of surprising it took that long. We all knew they were going to buy ETFs. They just accelerated that process. So first, let's go back. Give us a background in what you're doing with that trade now. It's gone up about a third.
Yeah, so and I appreciate that. Yeah, I mean, that was one of the things I was pounding the table on. And just to go over with people, here's the chart of the KWEB. You had it. I love this is one of my favorite patterns on a technical analysis basis to trade. I love these V bottoms right here. And then it takes this V bottom occurred in basically 6 months. And then it takes such a long time to consolidate, essentially forming this bull flag that when the explosive move comes, it's massive. And a couple reasons of why I was pounding the table on China. Number one, eight forward PEs on Alibaba, Baidu, and these numbers. And listen, you could say, yeah, there's a reason why that's so low. It's true, but is it really, should the U.S. markets really be 3x when you're talking about Microsoft or even more than that? And that's up for debate. And then, like you said, the China government, they have to maintain control, right? They have to, if they don't please their people, there's going to be trouble, and they have to. So there was just a matter of time until they stimulated. And then you just throw in the side note of how bearish everyone else was. And I love trades when everyone else hates something. And I think we all three agree here, whether it's crypto, whether it's stocks, whether it's commodities, when everyone hates something, it usually means it's going to go in the opposite direction. And lastly, David Tepper, Michael Burry. I mean, these are guys that have a proven track record, and they were loading the boat. And so I just say, hey, listen, I'm no David Tepper here. So if he's doing it, and I like the chart for the various reasons, I got to do it. But going back to this is what the heck do we do? I mean, is this stimulus going to work, Mike? I guess that would be my question.
Well, so I think obviously it's going to work for the stock market, at least in the short term. Let's go back and reiterate what I'm pointing out is China's demand is declining. China is, to me, and I've been making this statement for my view started 10 years ago, and I really started writing about it 2 years ago. They're going back to a very normal reversion, just like Japan did. Japan's total GDP right now is $4 trillion. It's the same as 1989. China's doing that now. It's the same as what Soviet Union doing. You're seeing it happening everywhere, and they're doing what you fully expect, and that Japan's been doing since 2010, stimulating their economy. But it's just not going to be. I mean, compared to what the U.S. did in 2008, and compared to what China did in 2008, this is nothing, and they're going to have to do more as it goes lower. But to me, that's the point here. I think that's more of a trade. They can support the stock market, but can they support commodities, demand for crude oil, demand for copper? And I'm like, no. So that's one of the key things I'll point out later is I think copper's worthy. If I was a trader and probably thinking about shorting here, you just got up around 10,000. It has to stay above 10,000. Stock market, U.S. stock market has to stay up, or I think the diamonds are tilt. So to me, it looks like a trade. So I would say with your trade with China, I suggest it's more of a trade than a trend.
And to be fair, so just so everyone's clear on this, I am out of those longs on China. I took my money and run. Like, one thing about it is I never try for a 10x or a 100x. I've clearly not been successful at that in my past. I like 20%, 30%, 40%, and I'm good with that. I don't need to do any more than that. I move on to the next trade. So Scott, what do we have here? What's going on in the world of crypto? It's kind of been a rough road, I would say. Bitcoin hasn't been holding up. Granted, it's still in the range it's been trading in, though.
Yeah. I mean, first, I was just taking a look at KWeb while you were talking about that because that's such a beautiful chart pattern. Well, I mean, what an incredible top candle, right? I mean, this was like the most gratuitous top. For those who love technical analysis, you can't get a more solid indicator than that. And this is an Adam and Eve double bottom, right? You have that V that you talked about, then the double. And it's actually just breaking out. So I would say that if you're looking at it from a chart perspective, this should be going up to like 76 from 37 here, just for the record. So if you were a swing or longer term trader, this is literally, I mean, you were in it and made a lot of money. But if you are a technical trader, this is just breaking out. I think.
Yeah. And just to be fair, on a pullback, I'll be a buyer. It's just, it's run so like 50% in a week or.
Oh, I like your trade. I love your trade. You're selling into resistance, right? I mean, that's exactly, you made the money, you hit the resistance, you're out. That's at 36.19. I just happen to be looking at that chart while you were talking about it. And it's pretty beautiful if you're looking for an education on technical charting patterns. I mean, I'm taking a look here at Bitcoin right now. I'll go back to the daily here. We just sort of have this pattern of high, low, lower, high, lower, low, lower, high, lower, low. And to be honest, I was looking at this as a low, high, higher, low, higher, high, and that we were breaking structure. Then I talked to Peter Brandt and I banged myself on the head and said, I'm an idiot. I'm pretty good at identifying chart patterns. This high doesn't count because it didn't make another lower low, right? So we still need to break 70K for Bitcoin to look good, right? I was thinking, hey, we broke 65. That's a total fake out, right? So above 70. I mean, to your point, we're now 160 to 170-ish days after the halving. This is when historically we've started to see things ramp up. We know that September was better than most Septembers. You take a look at seasonality. This was actually the best September ever at 7.29% up. Pretty actually incredible with the start that we had to the month being so bad. Obviously, we've never had, and these are election years and halving years, but we've never had a bad October after a bullish September, literally ever in history. Doesn't mean the history has to repeat itself, but we know that, M2 is increasing. We know that we're in election year. We know that we have the halving cycle. I still think we have a lot of tailwind narratives right now for crypto. And if you're a crypto fundamentalist, there's no better tailwind than this. Federal debt explodes on first day of the new fiscal year, jumping $204 billion to a new record of $35.669 trillion. But it gets worse. Treasury also had to draw down its cash balance by $72 billion. That's over $275 billion in red for just one day. For people tracking the national debt, we were in shock that they were adding $1 trillion every 90 days, right? Yeah. Now we're at $1/3 of $1 trillion in a day, or a quarter. I mean, this is like, I don't know how this ends, to use Mike's words. What stops it?
Sorry for that.
I really don't understand. But if you like Bitcoin because you think that it's a hedge against money printing and such, forget the chart, throw it away. This is a time to start to get interested. So listen, technically, I think Bitcoin is still kind of ranging. We still need a hell of a lot more to get excited. But I do think we have some tailwinds. And man, is our government a joke.
Yeah. No, I agree. The debt is a ridiculous scenario, and neither candidate's really even touching it with a 10-foot pole. So it's not going to improve regardless of who wins the election. It appears. And my big thesis, and Mike, you probably would agree with this, is that the politicians will do whatever they think is going to get them reelected or make them popular until the market forces actually force them. And we saw this. What was it, like 10, 15 years ago with austerity in Europe? Was that, am I right on that?
Greece. Yeah.
Yep. Yeah.
Yeah, I gotta piggyback on that one. I'm completely what you pointed about the deficit. I do have a scenario. It's kind of my base case that might play out, and that is, I expect we will get the first female president, piggybacking on Mexico, and then we will have a split executive and legislative branch, which is just what happened when Bill Clinton was president, which was the last time we balanced the budget. If you can get some checks and balances where you get a Republican Congress and they just check anything that the Democratic president says, that's least good for breaking down. But I want to point out a few things first. The problem right now with Bitcoin is its correlation to the S&P 500 on a 50-day basis is close to its highest in history. Not history, but 0.62. It's pretty darn high. So to me, deficits matter, but when you have an asset that's 3 times the volatility of gold, I'll stick with gold. And I want to point out just a few charts because I think this is the most important chart that's going to matter. It's a breakout no one wants. You take the gold divided by S&P 500, it's at 0.47. It's basically the same as it's been for 6 years. So all this, AI-driven stock market, yeah, big deal. Gold's keeping up. But if we break above this line, that's not good. It's just starting. I think it's going to. That's my technical. I'm just looking for confirmation, and there's a good reason for it. Volatility. This is just the 200-day moving average of the VIX Volatility Index. It's making a bottom from a 6-year low. If volatility starts creeping higher, I don't see what stops that trajectory of gold outperforming the S&P 500. Right now, on a 1-year basis, it's 10%. It's beating the S&P 500.
Mike, doesn't that thesis? I mean, it depends on how you define Bitcoin, obviously, and I know you wanted to talk about Bitcoin a bit more, but this money printing is a reason to buy gold or to theoretically buy digital gold if you believe in digital gold, correct? I mean, if you think that we're going to have out of control money printing, does that mean we buy a bunch of risk assets, or does it mean we talk about, hyperinflation and rush to safety?
So the thing is, as I pointed out right now, to me, Bitcoin now has a much higher correlation to the stock market than to the deficit. Deficit is a no. It ain't going away. It's going up. That's good for Bitcoin. It's much better for gold. And that's why I point out here, it's just ready to break out versus the stock market. And I also want to show you the key. We all know Bitcoin's the fastest horse in the race. And in a bull market, a lot of us have done well and made a lot of money. But that's my point is Bitcoin, this is just a simple chart of a 100-day moving average. Bitcoin's rolling over. Stock market, S&P 500, and gold are still rallying. Bitcoin's still doing the crocodile jaw pattern. Again, one thing factor. Again, I can't emphasize it much. Some of us made a lot of money on this signal in 2008. Is volatility is bottoming from a very low level. These are just 100-day moving averages. So it's one of those things I wanted to point out. And also, this is a key thing I like to point out is just look at the Bitcoin to gold cross. I mean, I've been watching this one since I was at S&P 2011, and it is heading lower. I mean, it's at 23 now. That's 23 ounces of Bitcoin. It seems like it's creeping lower, and I just overlay that with the S&P 500 versus its 100-week moving average. It will go back to its 100-week moving average. It's a question of does the 100-week moving average catch up to the S&P 500, or they will meet at some point. To me, the Bitcoin gold ratio is telling us it's going to happen sooner. And maybe as we head towards this election, the key thing I'll end with is not only see the geopolitical risks are picking up. We are in Cold War 2.0, and it's getting hotter every day, but we do have an election coming up. In the last election, we did not have a peaceful transfer of power. I mean, that's not priced in the market, the risk here from the next election.
Can I just bring up something, Scott? This is my hypothesis on why Bitcoin has gotten so correlated to the stock market. And let me hear your thoughts when I say it. So we had the spot ETF. The spot ETF made it very easy for John Q. Public, who probably didn't have a crypto account and was a hodler and so into Bitcoin, to buy Bitcoin. So you have a lot of new investors that are just regular investors. They don't really understand Bitcoin. They're just buying it because it's Bitcoin and it's an asset class. And therefore the moves in the stock market are more likely to trigger them emotionally to exit when the stock market falls or goes up, vice versa. Do you think that's a fair thought?
I think it's a fair thought. I just don't think there's as many of them as we think. So okay. I'm not sure that it's necessarily impacting the market. I would say more than likely we go through long periods of where things look correlated and long periods of where things don't look correlated. And I would say if we sort of had this top and have moved sideways and we're kind of 60,000 forever, right? I mean, we've been at, you could call it in either direction 10,000, but we've been at 60,000 basically since March. And so I think that it's hard to extrapolate much. I just don't see Bitcoin as dumping right now. Like everyone's like, why is it down? Why is it this? I literally said in March on this show and everywhere else, this is what would happen through this time. So I don't remember. And I didn't really have a theory on where stocks would be. So I'm the wrong person to ask, I guess. But to your point, I do think as Bitcoin becomes a more Wall Street institutional financialized asset, as we get options, which are coming for the Bitcoin spot ETF for BlackRock and surely for everyone else, as BNY Mellon gets approval to custody these assets, that also means that every single thing you can do with any asset class, you're going to be able to do with Bitcoin. That's going to be lending and borrowing and options and hedging and all the things that we're used to. That should smooth the volatility and make it more like every other asset traded on Wall Street with time. So maybe we're seeing the beginning of that. I just still think we're exactly where we're supposed to be coming into October.
So let me piggyback on that. That means Bitcoin at 3 times the volatility of gold and 3 times the volatility of S&P 500 is going to go down to maybe 2 or 1 eventually. It's a question of time. And it means we're in for a boring period. The best days of Bitcoin are over. The double, the 10Xs are done. Just pointing out facts, particularly as we have more and more participants, more and more ARB. Pointed out this in 2017, but when we launched those futures. But I want to tilt over to a little bit what I think is still going to be the next big trade. And to me, that's what's signaling. I showed you earlier, Bitcoin showing divergent weakness, and I stick with gold. I think it's still going to be the next big trade. I pointed it out a year ago in commodities. So far, that's worked. It looks like it's going to continue. But I want to show you my next chart, which I've been sticking with, and it's been backing up a little bit. But I just want to show you. I think it's still that U.S. Treasury long bonds, meaning TLT is backed up, but I think that's going to be part of the next big trade with normal deflation, probably led by the stock market. And I want to show you one key indicator. Bloomberg Commodity Index divided by gold. Look at that ratio. It's just heading downward. Why? Because gold's up for a reason. We have a shift in the world order. The biggest central banks in the world are on the planet. I'm buying it. You mentioned the unstoppable deficit. It's the safe haven. It's a place to go. But you've overlaid that with Bloomberg Commodity Index, and it has a very high connection with the U.S. 10-year note Treasury yield, right below 4% at the moment. To me, it's just a matter of time. This Treasury yield at 3.85 goes to the same thing we have in China, which is 2.21.
Huh. So just going back to yields, right? We've seen yields kind of stabilize. The dollar has even rallied the last few days. I didn't look at what the dollar was doing today, but one of the things that surprised me, right? We went through this period where we saw last month's jobs report being weaker than expected. And then recently we've seen jobless claims, which were kind of starting to creep up to 245,000. We're right back to 220, right? Back to kind of these historic lows, kind of the
until
low
they
end.
revise.
Right. And that's the question, right? But we did see JOLTS. JOLTS was up 400,000 month over month. We saw ADP decently stronger than expected. So is the economy really weakening, you guys, or is this just a fluke and we're going to get revisions and
I mean, Mike, you've showed the chart 1,000 times. There's never really been a time in history where unemployment ticks up without then going somewhat parabolic, to 6% or some level. I don't remember exactly what level you've had on those charts, but we've talked about it. Yeah. A number of times. And that's the only reason. I know we've said for a very long time here, the Fed won't cut until the stock market rolls over. Well, that was proven false, right? Because the Fed has now cut. Now they're looking at jobs.
Let's back up a little bit, Scott. The Fed, we had the biggest correction from July 16th to August 5th in the S&P 500. It dropped about 10%. It was the biggest correction since Q4 last year. And the Fed cut, 2 months after that? So we did have a backup. Now, okay, it's up on record high now.
But we talked about needing, 25, 30%. It's kind of revisionist history. At the time we were talking about, we were like, 10% is nothing. We still need that real mean reversion. I agree with you, by the way. So I made this joke on Monday that Matt Hogan from Bitwise came on my show and he said clip that I loved. He said, governments around the world have made recessions illegal.
Yeah.
It's not going to happen. Yeah. So maybe 10% is the new 30%.
Well, okay, so that's the point. When we start saying things like that, when you have volatility this low, market cap to GDP, the highest in 100 years, the highest stock market versus the rest of the world, MSCI ex-US in 50 years, the highest since the Bloomberg Commodity Index in 25 years, highest since gold in 15 years. I like to say overweighting risk assets in that environment is maybe considered imprudent. There's a lot of alternatives. Now, Bitcoin was a great alternative until March. And that's my point. And it was a great trade for certainly for those who were prudent enough to sell into that massive speculative rally, specifically in MicroStrategy. I mean, some of us who weren't allowed to trade Bitcoin, it was allowed to buy some of that. I'm like, that got stupid expensive. So now it's about, okay, what's the next big trade? And that's why I point out, I stick with what I'm really afraid is going to happen is just this little thing continuing lower, just following China. That means the number one factor is going to be for everything is the U.S. stock market. So that's why I could point out is Bitcoin will be fine as long as the U.S. stock market goes up. And if we have that normal correction, which you're not getting, it keeps going up, Bitcoin's still fine.
One of you may know the answer to this. Do you know that in theory, with MicroStrategy's current share price, what that's valued at in terms of what Bitcoin should be? I've heard.
I don't know.
I haven't done the math, but it's basically like MicroStrategy right now is as if Bitcoin was 125,000.
Yeah, so exactly, it got way too expensive. I mean, I watched the ratio. Yeah, but those proxies are just an example of speculative excesses. A lot of us have seen before in markets, and you don't want to buy into that. Certainly, if you're long, you want to be a prudent profit taker. It's one of those lessons you learn in trading pits. Don't mess with the market gods. When they give you a lot of money, take some. Don't. So that's as also I just been pointing about Bitcoin. Now I want to see that sign of divergent strength if and or when we get a little back up in S&P 500. But every single time that gold makes a new high, and S&P 500 makes a new high, and Bitcoin just hovers around 60 grand, to me, that's the problem. It's doing this. It keeps saying we got a problem. Like you point out, everybody says the technicals are great, but not compared to what matters for Bitcoin, and that has been the U.S. stock market going up.
Bitcoin's technicals are not great right now. Right, they're choppy, sideways, and in a generally bearish structure. So it's more about belief in the cycle or seasonality and obviously the fact that it's becoming more legitimate that you would trade on. Right, you don't look at the Bitcoin chart right now and say 60K. You have to buy if you're just looking at from a chart because there's no confirmation either direction. You could see 50 or you could be 70 and you're stopped out either way if you're on the wrong side of that trade, right? It's just not good risk adjusted as a trade. Now, if you dollar cost average it, you're loving life. I actually posted a tweet today that was really interesting. I went to this a website that I've used in the past that shows exactly what happens if you dollar cost average. So bring it up here, Gareth, if you can see it.
Yep.
If you started dollar cost averaging into Bitcoin roughly at the dead top of last cycle, so the day it hit 69,000, and just bought $100 a week, you spent $15,200, and you're currently worth $31,473. And Bitcoin, last I checked, is trading $9,000 below that first buy.
Yeah. Wow. So, I mean, that's long term. I completely agree. I got to show you my next chart because this was part of, I was at the Naples family office today. John Drew, thank you for having me. Got to present. And one key fact I like to point out is, to me, that's a good point. But the world changed on February 4th, 2022 with the Unlimited Friendship. Bitcoin was stuck in the middle of that. And this is just, you look at the performance since that day. I'm not cherry picking time. I'm taking a day. I think that the world changed because we went back to a Cold War. So those of us who remember the other one. And if you look at the performance since that day, Bitcoin and gold are both up about the same, 50%. But look at the total return of S&P 500, 32%. You're just getting, it's so wonderful that everybody loves AI, the AI-driven stock market, but the rock's beating stocks. And you look at the Bloomberg Commodity Index, it's almost down 10%. This is a global recessionary trajectory. It's one thing missing. If the stock market just drops 10%, just gives back some of those gains, it's the domino effect. What I'm worried about. Sure, the Fed might start cutting, but if you just lose a little bit of that sentiment, it just doesn't keep going up. Those of us who remember bear markets, that's what I'm worried about. So for now, it's great.
Do you explain this because as a part of the Unlimited Friendship, they're trying to de-dollarize and adding gold to the central banks? I mean, what's the reason that gold outperforms in your mind because of the Unlimited Friendship? And by the way, on the side note, there's another. I literally tweeted this today. An incredible All-In from the All-In Summit. I don't really even listen to the All-In podcast. This was just said to me, but John Mearsheimer and Jeffrey Sachs talking about the deep state, but foreign policy, and very specifically about the mistake the United States made by allowing the Unlimited Friendship. So a very big part of that conversation.
there was no choice. That we didn't allow it. It's that we're just the U.S. just happens to be the world's largest economic military power, and it's always going to have enemies. It was just history is going to look back at Mr. Z's decision, one person, as silly, I think. But the bottom line is that's emboldened completely the Russians' invasion of Ukraine. It emboldened the Iran antagonists and what's happening in Middle East, and it's just getting hotter every day because you have this major wedge against the U.S. now from China. And who's the largest buyer of gold on the planet? China, Chinese citizens. It's just accelerating. And when you're in war, you always go for the gold. That's the one issue. I still like Bitcoin, big picture macro, but it's 3 times the volatility of gold in the S&P 500. That's going to be a problem if and or when we get a correction. My point is the next key bridge is getting through this election, which is almost just a little bit over a month away.
Mike, are you a fan of? And obviously, you're a fan of gold. Are you a fan of palladium, platinum, and silver, or not as much?
I have to mention, I'm not a salesperson, but there's a product called GLTR. It tracks gold, silver, platinum, and palladium. I used to be at ETF Securities. That's now part of Wisdom Tree, I think. Those type of positions are very simple long-term positions. That one's up 40% this year. We has gold, silver, platinum, and palladium, and in a kind of a diversified portfolio, but mostly gold. And the key thing to remember here is gold's beating everything. It's beating virtually, and certainly on a risk-adjusted basis in commodities, and for a reason, because it's money. I mean, it's not so much money; it's the store value. Everything else is like, as Dave Weisberger says, all the time, gold's been demonetizing silver forever. Maybe Bitcoin's going to demonetize gold a little bit. It has been doing that, but right now, with this war going on, with volatility really high, and U.S. risk assets the most expensive in history, it's that default to gold. And that's one thing I like to mention is ETF holders, U.S. Investors haven't been buying gold at all if you look at ETFs, but they're just starting to turn. I mean, been selling a lot for 4 years, just starting to turn back upward. And I like to end with this is for the last 4 or 5 years, why buy gold with U.S. T-bills at 5% and the U.S. stock market on a tear? I think there's a sense now happening that might be reverting. That's why I point out this to me is the most significant wedge in the market. If we break above this, gold taken off versus the S&P 500, all the dominoes are going to trickle down.
So we just have a couple minutes left, and Scott, I got to ask you about this. Is that as weak as kind of Bitcoin has been, hasn't really, like you said, it's not like everyone's saying you got to buy right here at this point. But when you look at Ethereum, I mean, this is an ugly chart. I mean, holy cow, it's almost back to its lows. It's hovering right on support here. If it breaks this support, I have it going down to $2,000. What's going on? Why are the altcoins in Ethereum just lagging so much?
Well, some altcoins have been lagging so much. So for the first time over the past sort of months since that period where we saw altcoins, especially meme coins, somewhat fly in February and March, we've actually seen some relative strength in certain sectors of altcoins, right? I mean, Solana's been fine, but we've seen a lot of the new layer ones, Aptos, Sui, a number of these have actually had pretty sizable moves to the upside, which is an indication that people, even if it's animal spirits, they believe the cycle is about to cycle, right? The sort of thing I've described with having, you get 6 months of boring and then Bitcoin moves and people are preemptively sort of getting into altcoins. Now, Ethereum itself has been stuck between a rock and a hard place with narratives, people saying that it's obviously not as secure and safe as Bitcoin, obviously true, and not as fast and cheap as Solana. But I think that right now is a huge opportunity for Ethereum. First of all, you cannot believe in it at all fundamentally and still just see it as a beaten down asset that people think is going to zero that you can buy for a trade, right? And the flip side of that is when you look at what institutions are doing, BlackRock is tokenizing real world assets on Ethereum, right? So if you believe in the Larry Fink trade, he's also out here talking about Ethereum. I'm not making a value judgment as to whether Ethereum is too expensive or whether it's crappier than any of the other ones. I certainly don't think that it has the properties of Bitcoin as money. But as a trade, I'm very interested in a beaten down Ethereum, especially around 2000 there, as you show.
Yeah, no, I agree. I've been watching that 2000 level, and if it can come down to that, I was going to buy as well. Very cool, man. It's interesting stuff. I'll tell you guys. So we have jobs data tomorrow. We're about a month away from the elections. I think as of tomorrow, it would be a month away. You guys obviously think there could be some instability around the elections. I mean, Mike, you were mentioning everyone's not pricing that in, but we should be pricing in maybe not a smooth transfer of power.
Yeah, there's no risk price in markets at all. I mean, obviously making record highs.
Yeah.
I'm so just a little backup on payrolls. Our Anna Wong thinks this is going to be kind of a mad number. It's the October number that prints beginning in November. It's going to be the most significant one. We're looking for 125 payroll. Everybody's expecting that 4.2%. Not a big deal. We'll see how that changes. The numbers have been good. I mean, you have to admit ISM lately and ADP and claims, but it's the next one that's going to really matter. November, partly because of the strike and the hurricane, and we'll see how that works out.
Gotcha. All right, gentlemen. Thank you guys so much. It was great to be back with you guys. And thank you all for watching out there. Follow these gentlemen, please, on socials. And we'll see you hopefully next week. Have a good one, guys. Take care.